Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today is the governor of the great state of real estate, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing good. Just getting back at it. Hope my voice is recovered a little bit from all the talking at NMHC this week.
Well, we're going to talk a little bit about our takeaways from the National Multifamily Housing Council meeting in Las Vegas that we just came back from. Joining us in the conversation is the professor himself, Mr. James Eng. James, how are you?
Good. Our voice will be better than the day of NMHC that we did it a couple years ago in the library next to Aria. So this one will definitely be better.
That is absolutely correct. So James and Michael and I spent some time this week as we record this. We just came back from being out in Las Vegas. Again, we live in Dallas, Texas. We jumped on an airplane end of last week, beginning of this week, and we all went out to Las Vegas for the annual National Multifamily Housing Council meeting, which was at the Aria Hotel. It happens once a year, and it's been at the Aria, what do you think, twice in the last, say, 3 years? James, is that right?
That's right.
Yeah, and so it's the annual conference that everybody who's surrounding multifamily, from economists to developers to operators to management companies to lenders to equity to you name it, who's part of multifamily, they all get to network and talk about it while there's a conference going on sponsored by the National Multifamily Housing Council. And it's a big conference. I'm going to say there's maybe 10 or 12,000 people throughout the United States that shows up. So like all of us who are in the multifamily business, it's an opportunity for us to network and talk with other people and just kind of get the direction about what's going on. If you're kind of new to multifamily, you want to actually network a little bit too, and you want to get a little bit more knowledge about what's going on in multifamily. So we invite you to come to the Old Capital bus tour coming on in March the 28th. James, talk a little bit about the bus tour and what people can expect.
Every time I think we've done everything, we learn more and more that this bus tour seems to give people an idea of what is a C property, a B property, and A property. And a lot more networking, and some people coming in who are maybe they're general partners and they own a couple deals, and maybe a limited partner who's just getting started. So I think it's a great way to meet some other people interested in DFW and multifamily and just go sort of hit the streets a little bit. And that event is March 28th. And if we have a virtual speaker series, whenever we plan an event in February, it always seems to get snowed out or iced out. So we are going to be online next Wednesday, February 5th. We're going to be doing a virtual speaker series, and we're going to have two sort of big name limited partners on there. So go on to oldcapitalpodcast.com and you can register for both of those events right there.
Fantastic events. If you're thinking about getting into multifamily, you definitely want to attend both those events. One, again, is just be a virtual one. Just like James was saying, you want to RSVP to watch that online. And what really is, it's two limited partners that have invested in lots of transactions or advise people to get into these transactions and what they're seeing right now. And I think that's a very dynamic conversation. And the second one, the bus tour, is something that you want to get in and join us, jump on an airplane and travel out to Dallas. Remember what we are. We're bankers. We're not operators of properties. We're bankers, but we want to make sure that nobody loses any money. So we kind of go through just the basic of things that you got to know before you take your hard-earned money and put it into a transaction. So for the period of time that you can spend with us, hopefully I can tell you that most people who attend this, they learn a ton. And again, it's really, we get nothing out of it except for making sure that you are at least educated a little bit about the way us bankers take a look at transactions to make sure that you're safe. Let's talk a little bit about the conference. Again, we ask you to come in to see us, the people of Las Vegas at the National Multifamily Housing Council come in and ask us to come together at least once a year. And so I have some general takeaways from some of our discussions. James has some ideas, and then Michael has some ideas. again, I think there was some positive news that was coming out of it, at least on the macro side, that the fundamentals of apartment ownership and investing were starting to improve. That there was big headwinds in 2023, 24, and it kind of peaked downward when they changed the interest rates started to rise. And so a little bit to the phrase where Who Moved My Cheese, which I think was a book that came out 10, 20 years ago, just talks about where everybody was thinking the interest rates came down, the market would just accelerate and go far. But when the interest rates came down, all of a sudden there was a lot of challenges that happened when interest rates started to rise. So James, I'm going to ask you, what was your take? Give me a couple takeaways, your thoughts about what's going on in multifamily.
It seemed like there was just as many people. So nobody, even though we've seen people leave the industry, I guess they filled it with more brokers and more insurance guys and more tax guys. But it seemed like it was a full room just at the Aria. So, I mean, that was good. But, I think it started with probably, if you started at the top of the stack, sort of Class A stuff, everybody we talked to wanted to buy that stuff. Everyone who was lending wanted to lend against it. So that probably start there. That's probably the hottest thing is, the Class A deal coming out of lease up that's quote unquote below replacement cost. So I think start there. Everybody wants to lend against it and own it. The Class C stuff has been challenging, like we've seen. We haven't seen much trade. The debt is still there, which is probably the good thing, right? So agencies can still lend against it. But yeah, your retail LP money that haven't got distributions for the last couple of years has been challenged. And it's just taken a long time on this stress. So, besides Tide's portfolio sort of getting foreclosed and things like that, I mean, everybody else seems to be kicking the can pretty far down the road. And I was walking back to the hotel and I overheard this guy, and he said, look, the only way you get hurt on a roller coaster is by jumping out. So don't jump out, he was telling somebody. So if you bought a deal in 21 or 22, you jump out right now, you lost your equity, essentially. So you got to be able to hold these deals long enough. And I stole this from another guy, but, we had survived to 25. I'm going with persist to 26. So it's not going to be easy. It's going to be a little choppy, especially the front half, probably at 25, even the second half, maybe, to get the rent growth that you're wanting, but you got to make it through.
James, you might have been the guy who coined survive till 25, or the first guy I heard, but persist
early enough. Yeah,
doesn't ring as well. So
it doesn't ring as well, but yeah, I mean,
work on that a little bit. But
I'm working on it. Yeah, I'm working on it.
So James and I are bankers and lenders by trade, and then Michael's an operator of apartments. So Michael, what was your 2 cents? And we'll kind of crush it down to a little bit of other segments. High level, Michael.
6 things, just real high level. Then if you, Paul, maybe if you want to drill into some or all these with me and James, but you really kind of the 6 things I took away were fundamentals are improving. Rents, occupancy up, trending up by and large in most markets. It's all directly going the right way. I think that supply kind of coming in. There is, limited availability on the market of product to sell. The market's still pretty frozen. The bid-ask spread is pretty wide. It's kind of what James just mentioned. I'm starting to see banks open up. One of the bankers, a younger guy that we borrowed some money from, I told him how, back 15, 16 years ago, a year or two ago, I told him that the spigot's off. You told him when to pay you off, and then told us to pay him off on a couple things. And, a year or two down the road, you're going to come back on your apology tour and begging me to give you loans again. Well, that happened last week. So, banks are starting to open up because all their loans are getting paid off, and they realize they got to make loans to stay into business, right?
Yeah, they got to make loans to pay the bills and pay the payroll. And so if they're asking you to pay off all these loans, and you guys paid off $100-some million in loans, that was the earning piece of the bank. And how they realized when they looked right and left, they were like, where's all of our money coming back in to pay all of our expenses?
Yeah. Yeah. Now they're taking me to the Super Bowl this year too. So I get to go to the Super Bowl because they want some business from us. So anyway, so that, I think, as James also mentioned, everyone wants to buy this new construction below replacement costs. That's the bid-ask spread is still a little wide there. There's not a ton of that going on in the marketplace. Class C is certainly out of favor. B is a little bit more in favor, but C is out of favor. Everyone wants the newer stuff. I think everyone's expecting rates to stay higher think the rate cut, the Federal Reserve cutting the short-term overnight lending rate in September and a couple of times after that. And then the subsequent rise in Treasury caught everyone off sides. Everyone was expecting that to go further. So that's kind of got the mood a little bit more negative with a lot of people I spoke with, even though I'm kind of the opposite of that. And then finally, I think DFW is everyone's favorite market in the entire country. You know, we go from 15 years ago to be a second tier market. We're definitely a first tier market. I think everyone would rather put their money, 20 years ago it was New York, LA, DC, markets like that. Now Dallas Fort Worth is king of the hill, and everyone wants to come to Dallas Fort Worth. So I'm like the prettiest girl at the dance ball, the guy that controls a lot of access to deals in the top market in the country. So dance card was full, and everyone was lining up to see me. So it was kind of a neat experience.
Yeah, it's better to be lucky than good. We just happen to be living in the Dallas-Fort Worth market, and business is definitely changing the dynamics to going from these areas of Los Angeles, San Francisco, New York City, DC, and Maryland suburbs to Dallas, of all places, central part of the United States. So, James, what other points did you hear? Let's go a little bit of the minutia.
Trying to figure out how to work through some of these deals. We had some meetings with lenders. And, when these bridge loans were done in 21 and 22, we thought this thing comes crashing down. It's going to be 24, 25. But nope, nothing's happened. And we talked to one lender, and he was talking about how painful it is, though, when these deals stop paying for these bridge lenders to have to buy them out of these CLOs. And it basically uses all their cash up. So we're seeing a lot of new people come into the market on the debt side in terms of bridge lenders out there. And, whether, most people probably want to run back to agency, a lot of people are still doing bridge loans right now and just buying a strike that's sort of high, like probably 4 to 5%, but they're still doing bridge loans right now on these deals. And
so
a lot of people,
I thought like a bridge lender was the lender. Are you telling me the bridge lender is not the lender, that they actually had to go out and raise money from other people to actually fund these loans?
The reality is a lot of people tell us that, hey, you're not the lender. And I'm like, I get that. But then the lender is actually not the lender. The banks are actually supporting all these guys. And so a lot of times these bridge lenders, they get a warehouse line from a big bank, let's say Wells Fargo or JP Morgan or some of these guys. And then they lend off a percentage of that, and they have a little bit of equity that they put up to give you your loan. But then once they do the loan, they put it in a package and securitize it, and investors buy it. And so let's say you have $1 billion and it's 10 big $100 million loans. Problem is, if one of those $100 million loans start having an issue, then you can't pay your investors that you said, hey, we're going to pay you guys out over time with these loans. So you've got to replace that loan or put up additional collateral or buy it out and pay it off. And so that's taken up a lot of equity from some of the legacy bridge lenders out there. And now a lot of new lenders coming in, but then also a lot of these guys are switching out the GP. If, let's say, there was a $20 million loan that they gave out, and now they can only sell it for $20 million. They can either foreclose and sell it and be done with it, or they can sell it to somebody new and maybe give them a $17 or $18 million bridge loan at 90% leverage. And then someone can come in with limited equity and keep running that deal because the existing guy just is out of money.
It's amazing. Michael, let's talk a little bit more about minutia. What was your take on all this inventory that was being built for the last couple of years, and now all of a sudden it's starting to go away? You guys are buying a property that's a fairly new property, and you're getting kind of a discount to the market. Is there other discounts to the market are you seeing out there on some of these properties?
Yeah, kind of few and far between. I mean, I think it's we've seen like I said, limited supply. So I think two things are happening. Like a lot of these developers are, not wanting to take where the market is generally pricing. So you've seen some of these transactions go out. Expectations are high, and the offers come in lower than that. And then these builders say, I ain't selling, right? I'm not selling this value. So they pull it back and doesn't transact. So there was a lot of deals that went out in the Labor Day time period, kind of fall last year, and that's when rates were rising. The treasuries didn't trade because the value was lower than what they were expecting. So I think you're seeing that. So it's kind of few and far between. So you really got to work real hard, to try to find it. And, with the deal we got in escrow, we're doing with a large fund out of Europe. And it was a deal we chased for 5 years. It was a single owner, and he, didn't want to sell. Finally, he had a health reason, and he needs to sell because he's in his 70s and needs to move on. But that was something that took us 5 years to kind of get to, and then once we agreed to it, it took us 5 months to get in the contract. It was a real grind. I think what you're going to see, like maybe lenders forcing sales, I think that might be more on the lower end. And to James' point, to date, they really haven't forced it. And if there has been some change, it might have been the kind of has use Paul People's analogy, kind of swap out the jockey on the horse, right? So they go from this sponsor to that sponsor. But it seems like maybe more of that might be kind of loosening up, or some of these maturities that, the 21 and 22 originated deals are now kind of needing to refinance or have some sort of modification of loan because they're coming up for maturity and they're going to put it out. But just really hadn't happened yet. But yeah, that Class C stuff is definitely out of favor. I think B is in a little better shape. So kind of starting to think is now the time to go back in time and buy some older stuff. We've been thinking about that for a few years now. And is it really time to jump into that? Because there's just not a lot of appetite for it. So if some of these deals start clearing at pretty high cap rates, I mean, you got to think, Paul, that your taxes are probably higher than what they'll be in the future because if these values get reset, you should lower the tax base, taxable value. Insurance, we've seen the big move already in insurance, so I think that's already kind of baked in the current P&L. So I don't think you're going to see dramatic jumps in insurance from a percentage standpoint. Payroll's already high, maintenance and turnover and R&M and all that stuff's already moved with inflation. It seems like that's kind of getting subdued. So you probably have your rents are falling, so you're probably at a low point in rents and a high point in expenses. And if the cap rate goes up to a pretty attractive number, to James' point, you could borrow money in somewhere in the fives today, probably with an agency loan, maybe kind of high fives or as low fives, 4 months ago. These cap rates are 7 or 8. I mean, you could probably qualify for 80 leverage with Fannie Mae, and don't think you have a ton of risk of rents falling much lower, and a ton of risk of expenses jumping up like we had the last few years. And bad debt seems like that's probably the worst of bad debt's probably behind us too. But sentiment is just real bad on Class C right now. I'm not saying I want to go buy a bunch of 60s chillers deals or anything like that, but maybe your 80s deals, something like that might start making sense. I mean, I think there's a very contrarian opinion to everyone I spoke to out in Las Vegas.
You mean nobody was pitching a B or C deal to you, Mike?
No, but no one wanted it. We talked to equity. We didn't really talk to brokers.
Okay, yeah.
And none of those guys wanted that. I mean, and so it just seems like, okay, no one wants it. And to Paul's point, it's hard to raise money for it, et cetera, et cetera. I mean, but at some point, price is a great equalizer, and this might be the beginnings of time to start considering it. At least that's what I'm thinking a lot about here. I haven't really pulled the trigger in wide scale, but I'm kind of starting to think about it.
Yeah, I didn't want to put this in a post, but I was like, is Class C the new office? Like, is it that bad? But there's still debt, right? There's still debt for Class C. So you're only bringing 20%. Like, office got a problem of there's no debt for the deal. So you have to buy it at such a low basis, but then office is now clearing. Class C isn't as bad as office.
I was just going to talk a little bit more about the sentiment of people out there. One of the things I think, James, after we went to our third or fourth party, and it was just getting out of control, where drinks were flowing and conversations were flowing, James said to me, "What recession in multifamily? This is amazing that the money that's being spent by these investment bankers and investment salespeople on these parties that are going on." So I don't think, to a certain extent, a lot of people don't recognize the troubles that are going on in the multifamily industry. So I think there is a little bit of an analogy to be made, or a parallel with office right now versus C-class properties. Even though there is debt, it's kind of the abused multifamily property space that I think we all have very concerns about, because these properties are not 20 years old. I mean, they're 40, 50 years old. And we spent some time with an economist, James and I did, at this meeting. What were some of the takeaways from the economist, James?
Too many. I mean, we asked them about everything from immigration to tariffs and everything, just trying to get predictions. I mean, I think the one thing that was interesting was, his platform covers affordable housing. I guess that's big A, affordable. And he was saying, even in Austin, affordable properties are 85, 86% occupied right now. And they've never been that low in occupancy. But just the amount of supply, the amount of concessions in some markets, that the competition, these people who typically live in affordable properties, they're jumping up to A stuff. it's a struggle in some of these supply heavy markets right now. But overall, I mean, his take was that, it's going to take a little bit of time, but the supply is going to slow down and we'll be all right. And the rent growth will come back. And he's still long-term positive.
I remember the last time that we had a large recession, so to speak, back in 2010, 11 or so. So when we stopped building single family homes in and around the Dallas-Fort Worth area, all the people that did all the trades, whether it was the plumbing or the roofing or the framing of these homes, these single family homes, when there was no money really to have people, single family bankers weren't lending money out anymore, and nobody was buying money because there was so much inventory, because there was so many subprime loans that were going south in the marketplace. Well, the people that were living in these Class C properties that were, let's say, were Hispanic, if they weren't getting income coming in, they all picked up and left to go back down to Mexico. And it was just not one family. It was like 3 or 4 families that are tied to some of these properties. And so the vacancies jumped up during the period of time of 10, 11, 12, where people were not getting paid. And there was such a negative feeling about construction coming back in, is that a lot of these properties suffered. So I don't know if that gets interpolated back to some of the immigration issues that the United States is going to be facing with Trump. Are we going to start to see some of these Class C properties get affected by people jumping out of some of these buildings? I mean, yeah. Mike, what's your take?
I had two people bring that up to me. I hadn't thought about that as far as like the renter going out, getting evicted or deported or leaving the country. I haven't really thought that much about it. So it's probably something to consider as you're looking through pockets of town and specific properties. Is that, a higher or lower probability for that? But from fundamentals, I'm going to tell you, as a guy that owns properties in Dallas-Fort Worth, the best market in the country for, or at least most sought after market in the country, maybe the best. And Austin, one of the highest supply in the entire country. We're seeing fundamentals firm up in real time. We're going to see rent growth in Dallas-Fort Worth, and I believe San Antonio in Q1. March, I think we see rent growth. It's we're full. We're like across the board, mid 90s. Even in Austin, we're reasonably full. Came out the cost of rate. We had to drop rental rate, especially in the fourth quarter, but we're full. And the thing that's different this time, Paul, when we were on the business back in the bad old days, 15, 16 years ago, was, one of the biggest differences that we've seen here recently is we have the revenue management software that's pretty sophisticated. They had kind of like the generation 1 of that back then, but now we have the software, and it was great in 2021 when we all got 20% rent growth on the way up. And the inverse is true now, that the last 18 months we've seen pretty meaningfully lower rents, especially like in a high supply market like Austin, where you got negative growth of double digits and rental rates. But now that we're full, the way this thing works is the pendulum's just swing back the other way. So one of the things I've really been thinking about, like kind of what was the prior peak in both value and rents to where the kind of current trough is, and how long does it take to get back to the prior peak, right? So like for those that are unaware, my view, and Paul, correct me if you have a different opinion, but kind of back the Great Recession from like value. The peak value was probably somewhere first half, give or take, at 2007. Somewhere in that general vicinity was kind of your peak, and the trough was probably 2010, some point in 2010. And we generally got back to prior peak for valuations by and large by, say, 2013. Kind of got back to where the getting a 7 value was. Not every deal, not every case, but just probably on average. Maybe some of the tougher stuff took a little longer to get back there. So, your worst locations, your worst properties probably took maybe till 2014 or 2015 to hit that prior peak. But, here the peak was clearly Q1 of 22, like right around the first of the year, 22. The trough is probably behind us, now, or behind us. I think for Class A, it's definitely behind us. I think maybe workforce housing is probably bottoming out around now. I think sentiment's just freaking terrible. So, we just haven't had a lot of trades. And, I'm kind of thinking this is not as bad as that was 15, 16 years ago. So we're probably back to prior peak in some point in 2027. for values is probably by and large, and that's only, a couple years away. So as bad as it seems, if you just hang out a couple years, I think you're generally back to prior peak. That might take longer for the workforce housing stuff. So, if you have an old deal, that might be 28 or 29, but for Class A, I bet you is probably 27. And then for rents, I mean, I think the peak rent was some point in 2023 for us here recently. The trough is probably now for the most part, maybe a little lower to go in a couple markets, but I think we bottomed out in say Dallas Fort Worth. And I think prior peak is we probably get back to that 2023 rent at some point in 2026. I think we start, maybe it doesn't fully penetrate your rent roll, but I think the asking rents get there. And I think this revenue management software is going to swing it so much quicker than we all think. Might be that first 10 or 15% jump in rent is like overnight. Then maybe the next 3% is 12 months to get that next 3%. But just the way the revenue management stuff works, I mean, if we're 95 or 96% physical with a 94 or 60-day forward trend, the rents go up a lot. And then if they don't sign anything, they'll start gradually going down. But if you hit one of those rents, then the next one goes up and goes up and goes up. So I think it's going to come back quicker than a lot of people think, and I think the technology is going to support that. So that's my view, and I've reserved the right to be wrong, but that's what I think is about to happen.
Yeah, the revenue management system is absolutely fascinating because it's like trying to buy a ticket on the airlines or trying to get a hotel room. The closer you are to the time that you actually need that flight or need that hotel room, it could be a lot more expensive to do it. So
unless the plane's that full, and then it'll be cheap, right? And
that's right.
I'm telling you, the plane's full right now. And the stuff I have, right? I mean, there's exceptions to all this. And it's probably
but you were talking about this about 2 weeks and a half ago. You were talking with your property management company that can use third-party property management with your asset. You guys are an asset manager, but you're saying that occupancy is higher and rents are a little higher right now than they have been the last 2 years.
Yeah, like we've been playing defense for 18 months, and it's like it's time for offense. From an operational standpoint, we own Class A and A minus by and large, and a handful of B class deals, but the vast majority is newer, nicer, bigger, prettier. So maybe I'm not seeing a lot of the struggles that a 1960s chiller deal probably has, which is just different. So I'm sure the results will vary, but that's what I'm seeing. And that's what I kind of expect to happen.
Yeah, your occupancy's higher, and your rents are a little higher for the last say 60 to 90 days.
Yeah,
so
James, are you seeing differences in the stuff you're looking at? Is it tougher still?
It's still tough. I mean, when I talk to guys who own BNC, I mean, they're still having to give 500 to 1,000 a month, or sorry, like just upfront concessions to these guys. Where you were thinking you would only have to do that on the Class A stuff a month or 2 months while something's in lease up, but across the board on this BNC properties, they're still having to give $500 gift card to get you to move in. But going back, Mike, I pulled up Green Street. It's not the apartment index, but it had September 2007 at 100. So think of that as sort of your top point. And then it got back to 100 in April of 2013. So it took 6 years to come back. And then, so that was at 100. And then the next peak was Q1 2022. It was at 155. Okay. And right now they have us down the trough sort of December 23, January 24, 121, and it's come up to 127. So we still got
Class A, right? That's what
this. Well, this is actually across everything. This is just overall sentiment, not necessarily.
But
so
extrapolate that to our business.
Yeah.
I mean, I think the floor of Class A was probably when the 10-year Treasury hit 5%. September 23 or October 23. That's when the sentiment was the worst, right?
Yeah.
And it's improved marginally in the Class A stuff. And I think that what you're kind of combine the last two thoughts you had, the filtering of your tenant base, and they're going from Class B to A to chase that special on the lease up, and then C to B, and then affordable to C, or whatever, and then the affordable and the lowest quality C are struggling the most right now.
Yeah.
Now that supply is turn the corner. We're post peak supply. It's rapidly coming down. These buildings aren't offering all these concessions because they're already full. Now you're starting to see these rents kind of creep their way up on the Class A, and it hasn't trickled all the way down
yet.
The older stuff yet, but it's just a matter of time when these A's rents get so high Like, I get priced out of this, I got to go back and buy a
move.
20, 30-year-old building or rent a 20, 30-year-old building and so forth and so on. So I think that's kind of what we're just seeing, the swings of the pendulum, and maybe why I'm a lot more optimistic than some of the other people. And back to Paul's point too from earlier, hell, we were talking for years, Paul, about how the cap rate compression didn't make any damn sense, where used to be a 300 basis point spread between a Class A and a Class C, and it got down to, next to nothing. So the risk of these C deals,
They were all the same.
A lot higher. And then now, as cap rates have blown out, they're a lot stickier on the top of the property grade and then blowing out a lot more on the lower end of the grade. But at some point, those cap rates blow out enough that it makes the risk worth the return with the risk to go back in time. And if you can get 80% agency financing on a no BS underwriting, I mean, that's probably a pretty good time to buy, and when they're talking to one of our good buddies or one of your guys' banker or my banker, back in 21, he was a agency lender on Fannie Mae. He said he quoted, I don't know how many deals, hundreds of deals, and the average LTV was something like 45% was what his quote was. And all these deals were getting done at, 75, 80% leverage with bridge debt. And he's like, I wasn't being conservative. I was aggressive trying to size it. And I still was 45%, and then now he can probably
That was pro forma. Yeah, that was pro forma expenses, but
yeah. Now he can size a lot of these deals, 75, 80%. So, at some point it's the price is low. So it sucks if you bought one of those deals, but that's ancient history, and here we are today. And how do we make money going forward? I mean, it might be time to start dipping your toe back, within reason, the right deal, and know that maybe you have 6-9 months of pain from fundamentals ahead of you on the workforce housing, but that should kind of directionally start getting better.
Mike, let's say the lender came to you and was like, look, this guy paid 30 million. I got a loan of whatever, 25. You want to buy this deal for 25? I'll give you a loan for 23 million. You come up with 2 million. You take over this 200 unit Class B minus deal. Do you make a run at that, or what's your thought process on making a run at a deal like
it's
that?
juice with the squeeze, right? So
Yeah.
it's,
Can you double up 2 million?
Like, you have 2 million in it, but like if it's, he's asking 25 million and give me a $23 million mortgage, so I think the property's worth 21, and then I'm in a hole, and I just got to really grow my way out of it. And then like, how bad's the situation, right? So I know a lot of guys have done that, and good for them, right? But we're a little bit more established than. If I was a little younger in my career, I might be a little more eager to do that. But having a little bit of fee income and a lot of headaches, I don't know if it's really is the juice worth the squeeze relative to just going buying a big deal right now.
Yeah.
So that's a lot of the way I would think about it. So I think a lot of those are still a little rich on their values, what they're trying to clear them at from the banks.
Yeah, you're thinking, well, maybe if the lender takes a haircut at 5 million. And I just buy it for 20, put agency debt at 15, then it makes my life a lot easier.
14 even, whatever. Have more money in it, but it's not, so much damn work.
What is your take, guys? Common knowledge, because I don't have any specific numbers in front of me, but we talk about distress in the market. Everybody wants to come and try to buy something from somebody that's losing their shirt, and they want to get a deal. And I'm going to put those air quotes. Give me a deal. Find me a deal out there. Let's see what's available out there. And I don't see a lot of distressed deals out there. There are a couple distressed deals, but the size of the market itself, we just go back and we take a look at it. Out of 100 deals, how many were done with bridge loans and how many were done with bank loans or CMBS or agency financing or whatever? And I'm thinking that maybe it's 12 or 13, 14% were done with bridge loans during that period of time that they've traded.
What do you mean, like the last 12 months or so?
Yeah, last say 24 months. Like if you're looking at deals right now, what are you seeing out there in the marketplace itself? Are you seeing agency transactions?
I mean,
that were on the books?
Done has been 65% LTV, Fannie or Freddie, 5 to 7 year fixed rate, and I think that's probably the vast majority of my peers and the stuff I've been looking at. I don't know, James, what are you kind of seeing in the older vintage?
Yeah, for sure, agency 5.7 is. I mean, a lot more people are just doing 5. And the only stuff that's really going bridge is either super nice A-class stuff where they're a lot smarter than we are and they could pay off the loan with a check. So they're okay doing a bridge loan because they don't want to deal with it, or they don't want to deal with agency and they can't get the leverage. Or the situation we're talking about where the current lender is cutting that person a deal to come in and be the new airline pilot on the deal. And they're giving them a good 85, 90% leverage on a floater and just resizing their loan, really. But
Yeah.
pretty much everyone else is doing agency on a lot of these deals.
Well, I mean, really what I'm trying to figure out is a lot of these transactions out there in the whole market itself, they're not all bridge loans that were done back 5 years ago, 4 years ago, 3 years ago, 2 years ago. There's only a certain percentage of the entire market that was done with bridge lending, and we kind of hold a spotlight on those and saying that is where the market is, but it's not. It's just a certain smaller percentage of the market itself.
Well, I think about it this way, Paul. So especially probably most of the multifamily deals that were done on say like 21 through first half of 22. I don't know how much of the say Dallas-Fort Worth market turned over. In any given year, it's probably 6 to 8% of the market turns over and trades in a normal year. And it was probably like in 21, I don't know, 20% of the market turned over or 18% of the market turned over. And if at any given year, maybe 80% is permanent debt, 20% is bridge debt, I would probably say it was more like the opposite. It was probably 80% bridge and 20% permanent in that time period. So you're probably talking somewhere around 15% of the market is potentially some level of impairment to varying degrees. And
that's what I think too.
Yeah,
think
more on the lower end workforce housing and lesser on the nicer stuff, and lesser resources on the smaller, older deals from the sponsor profile than you do on the nicer, larger deals. So, but probably in that time period, say 15% of the market had some level of stress to it. But if you bought your deal in 2021 and put a 10-year fixed rate mortgage on it, you probably had a 3.5% rate, and maybe your rents are down, but it's not, end of the world.
Yeah, there's not a gun to your head to try to get it. Right. That's it. Let's finish up just on our conversation and on our visit to Las Vegas for the National Multifamily. I think what my takeaway really is that I think everybody wants to be kind of a net buyer of multifamily right now. They want to buy more stuff than they're selling, but the prices don't exist and the assets that are on the market, so at least of any scale. So they have to figure out how they're going to put it together. But they want to be net buyers of real estate. James, what is your 2 cents finishing up?
I would say the brokers were more optimistic than the operators that we talked to. Most of the operators, I'm not saying they've been through war the past 2 years, but some of the guys have been through some challenges and it's been a little bit more painful. And most of the brokers actually at NMHC, they were guys who had been around for a while. So a lot of the newer guys, they're not in the business anymore. So they've been through this before. And like we said, like in 21 and 22, it felt like prices would go up forever. Right now, it feels like prices are going to go down forever and rents are going to go down forever. But like in 12 months, like Mike said, it might snap and be right back. But it does take time. When I talk to some of these guys who have been through some tough deals and, the property's running out of cash, it is not fun. And for your deal to go to special servicing and for the, all the cash to be swept is not fun. But I think as a general partner, you've got to, same way that you communicate good news, you got to communicate bad news and let your investors know what's going on, because a silent GP is people think up all crazy stories of what's going on with their investment. So if you're out there, I would say over communicate with the lender and over communicate with your investors. Even if it's not good news, at least it's news. And, we're all big boys and girls and we can handle it.
Yeah, I talked to a group that had done a lot of value add multifamily at the Peak Bridge and large fund, right? They've gone through and said, okay, what deals do we want to keep feeding and what deals do we want to cut bait? And they're going to kind of cut bait and go. And I know Paul invested in a deal with a different operator, and you were telling me how they're finally kind of cutting bait on it. So I think you're starting to see a few guys say, okay, hey, I'm out of cash. It's time to cut bait. But those are by and large on the older side. I don't think you're really seeing that on the newer side. And you're not seeing these developers really capitulate and scale on the newer stuff and go to market. And, Austin is the slowest I've ever seen it in my entire life. There's just like nothing out for sale in Austin. It's just staggering how limited the supply is out there. So, but I do think that there's opportunity right now, especially on the older end of the scale. And, I think it's going to be better sooner. And it doesn't feel like that because I think we're all traumatized. but I'm starting to see the first signs of green shoots. And whatever that economist you guys were talking about, you were speaking with, it goes from being Mr. Negative to Mr. Positive. We see a positive rental rate growth print in the city of Austin. I think, values gap up 10%. Because I think people are going to say, "Oh, we got to get going." And once this market gets a little bit of inertia, not that it's going to go, from 0 to 100, but it'll start picking up steam as you go. So, I'm again bullish. Try to buy as much as we can. We've been on that for a little while, and I think, I also do think interest rates are probably due to come back down, and we've seen a little retracement recently. I think, it's been pretty negative sentiment ever since they cut the rates and the rates went up on the longer end of the curve. I mean, I think that's maybe a little bit overdone, and we're finally seeing housing shelter component of the inflation finally trickle into it. So the base effect is such that we should start seeing hopefully progress on inflation and lower prints just because of the shelter component, which I think gives headroom for even more cuts. So there's two cuts priced in right now. I'd probably take the over for 2025. I think we get over 2 cuts, probably 3 to 4 cuts is kind of where I'm thinking. Maybe that's backloaded in the year, but that'll also be helpful if we get that. So, I mean, no one's going to wave the all clear banner for you. You gotta kind of make decisions with imperfect information. But, if you could buy at today's levels, if you liked it in 21, you should love it today, right? I mean, the values are down and starting to see rent growth, and supply is, dramatically tapering off, and it's going to be a while before they can deliver supply and scale. So it should mean rents go up. And with that revenue management software and technology we have, the rents will go up quick. And then if they hit them, they'll keep staying high. If they don't hit them, they'll start trickling back down. But I think the trough is in, and we should be buying.
I agree too. I think it's a net for buyers for people that are thinking about coming into the market to start buying. I think this is the time to consider it. Spend more time meeting people. Like we went to Las Vegas. We want you to come to Dallas and spend some time with us. Not to say that we're the best, but I mean, we have a lot more experience than a lot of operators of multifamily properties out there. We'll tell you the goods, the bads, and definitely the uglies that happen out there. And so if you're thinking about putting in $100,000 or $200,000 into an opportunity that you see out there, make sure you get a little bit of education about what's going on.
One thing to teach you guys, Warren, I mean, talking with some of the guys that really have problems out there, a lot of them took real high octane money that had really aggressive lenders that are kind of loan to own and real sharky terms in the term sheets. And when the guys get a little bit of trouble, they're, working to, try to take the property over, sue their clients, enforce bad boy carve outs. Where a lot of the banks and different lenders you guys put people in really weren't like that, right? Because you know that that's bad news, and as long as if the deal goes good, you're fine. But if there's any bit of trouble, that bridge lender is there to take your head off, not help you work through the problems and get to the better time. So that's a lot of I think the guidance you provided some of your clients over the years.
Yeah, I think you're right, Michael. All right, so just high level of discussion on the National Multifamily Housing Council convention in Las Vegas. I think it was very positive. I think it's going to go on about this time next year. So we certainly look forward to seeing everybody coming to the Old Capitol bus tour on the 28th. Again, we have limited space on that one. If you're thinking about coming, make sure you sign up for that, even though it's end of January, beginning of February, we will be closed out by in the next week or two. So make sure you go to oldcapitalpodcast.com and sign up for that event. Again, I want to thank Michael Becker. Thanks for spending some time with us. The professor, thanks for spending some time with us today. Go out and make it a great day, and we'll talk to you soon. Thanks.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.